Digital assets and clearing infrastructure. What T+1 didn't solve. T+1 settlement compressed the window between trade and settlement. What it didn't do? Rebuild the infrastructure underneath. 3 gaps remain that T+1 couldn't fix. 1. Prefunding. Digital asset markets still require participants to post the full value of a trade before execution. Traditional markets don't work that way. That locked capital is a structural tax on institutional participation. 2. 24-hour markets. Settlement cutoffs were designed around business day windows. Digital assets trade around the clock. The infrastructure hasn't caught up. 3. Interoperability. DLT-based settlement platforms remain largely siloed from traditional CSDs, CCPs, and RTGS systems. ESMA flagged this directly in its June 2025 DLT Pilot Regime review. Without connectivity, tokenized transactions can't support margining, cross-platform transfers, or straight-through processing at institutional scale. The build is underway. DTCC received SEC no-action authorization in December 2025 and is now working with more than 50 firms to roll out a tokenization service in H2 2026. ClearToken's DVP settlement service is live with FCA authorization. The Canton Network is already supporting over $4.5 trillion in annual trade flows. The regulatory floor is also solidifying. The Genius Act established the U.S. stablecoin framework in July 2025. The CFTC opened the door to tokenized collateral. The EU DLT Pilot Regime is under major expansion. MiCA reaches full enforcement July 1, 2026. T+1 was necessary. It wasn't the finish line. I've written a full analysis of what this transition requires and what it means for institutional market participants. Link in comments. What gaps concern you most? I'd welcome the perspective. Subscribe to Flat98 on YouTube and follow us on LinkedIn for the regulatory story behind the headlines.